The banking sector remains stable, sound, liquid, and profitable, even as banks continue to adjust to the impact of the DDEP. The sector's capital adequacy levels remained above the minimum regulatory level with regulatory reliefs, with most banks carrying excess liquidity. The industry's NPL ratio increased to 18.3% in October 2023 from 14% in October 2022 and 15.7% in January 2023, reflecting elevated credit risk associated with the effects of the macroeconomic crisis of 2022. Profitability continues to improve as banks continue to invest in high-yielding, short-dated Bank of Ghana and Government of Ghana instruments. The banking sector showed some resilience as the various stress tests on bank capital following adverse macroeconomic shocks pointed to stability. Developments on the international commodity markets showed that prices of Ghana's major export commodities recorded gains relative to price conditions at the beginning of the year. Since January 2023, crude oil prices have registered a 9.1% increase to $88.7 per barrel in October 2023, driven in large part by concerns about global supply shortfalls arising mainly from the extension of production cuts from Saudi Arabia and Russia. Cocoa prices have risen sharply to levels last seen in the 1970s to $3,603.3 per ton in October 2023. The 41.9% increase in cocoa prices is mainly attributed to mounting concerns over tight supplies in Ivory Coast and Ghana, stemming from adverse weather conditions. Gold prices gained 6.6% to settle at $1,913.79 per fine ounce, largely due to expectations of a pause in the U.S. Federal Reserve rate hikes and demand for the commodity on account of its safe haven status amid heightening geopolitical tensions. There was further improvement in the trade balance over the first 10 months of the year, reflecting the generally favorable commodity prices alongside import compression. The trade account indicated a higher surplus of $2.1 billion for the first 10 months of 2023, relative to a trade surplus of $1.8 billion in the same period of 2022. This was driven by a greater reduction in imports relative to exports. Total imports declined by 8.9% to $11.4 billion, driven by both non-oil imports and oil and gas imports. Non-oil imports were estimated at $7.7 billion, down by 9.3%, while oil and gas imports also declined by 8.1% to $3.7 billion. Merchandise exports also declined by 6.4 billion to 13.4 billion dollars, and this was weighed down by crude oil exports and cocoa products. Of the total, gold export earnings increased by 13.9% to 6.1 billion dollars, benefiting from both volume and price effect. Cocoa bean exports also increased by 6.1% to $1.1 billion on the back of higher volumes. In contrast, crude oil exports decreased sharply by 33.5% to $3.1 billion, mainly driven by reduced volumes, while other exports, including non-traditional exports, decreased marginally by 1.1% to an estimated value of $2.6 billion. Data up to the third quarter of the year shows that the current account recorded a surplus of $1 billion, in contrast to a deficit of 1.8 billion US dollars recorded for the same period of 2022. The surplus was driven by improvements in the trade account, a sharp drop in income payments, and strong growth in remittance inflows. The income account improved significantly on the back of the debt standstill, which led to a sharp decline in net income payments by 56% to 1.4 billion US dollars, and in interest payments on public debt by 89.8% to 134 million US dollars, compared with 1.3 billion US dollars in the same time of 2022. Remittance flows, however, increased to 3.2 billion US dollars compared with 2.5 billion US dollars in the same period of 2022. The capital and financial accounts are benefiting from reduced portfolio outflows and lower amortization payments. The capital and financial account recorded a net outflow of 1.5 billion in the review period, slightly lower than the 1.6 billion recorded a year earlier due to lower portfolio payments and reduced government amortization. In the period, portfolio outflows reduced to 195 million US dollars compared with 1.9 billion a year earlier. Also, government's loan amortization declined by 41.7% to 523 million, mainly due to the debt standstill. Foreign direct investment also moderated to 926 million US dollars from 1.1 billion US dollars in 2022. The favorable developments in the current and the capital and financial accounts impacted positively on the balance of payments. By the end of the third quarter, the trade surplus, current account surplus, lower capital outflows helped the overall balance of payments deficit to 617 million US dollars in the third quarter of 2023, from a deficit of 3.4 billion in the third quarter of 2022. Gross international reserves, excluding pledged assets and petroleum funds, reflected a build-up. The level of reserves, as defined under the IMF program, increased to 2.5 billion, equivalent to 1.1 months of import cover at the end of October 2023, from the December 2022 position of 1.5 billion, that is 0.6 months of import cover. This indicates a build-up of about 1 billion US dollars, driven mainly by the Gold for Reserves program. The above favorable external developments and tighter monetary policy stance have resulted in a relatively stable cedi in the year so far. Excluding the sharp depreciation of 20.6% in January, the Ghana cedi has cumulatively depreciated by 6.6% against the US dollar between February and November 20th, 2023. The relative stability has largely been supported by inflows from the IMF ECF first tranche, the domestic gold purchase program, as well as purchases of repatriated export proceeds from mining companies and oil and gas producers. Summary and outlook. The committee noted that tighter financing conditions, slower growth in manufacturing and services sectors, and China's slower recovery were exerting some moderating influence on global economic activity. Earlier aggressive policy tightening by advanced economy central banks has contributed to the dampening of inflation pressures, with headline inflation decelerating in many of their economies. This has led to a pause in the tightening cycle. But core inflation remains high and is declining slowly due to strong labor markets. In the outlook, central banks are expected to maintain policy rates at high levels for much longer periods to contain the still elevated inflation levels relative to targets. The prevailing higher policy rates, long-term bond yields, and renewed strength of the US dollar could continue to keep global financing conditions tight with consequences for emerging market and developing economies. Furthermore, rising geopolitical tensions is creating uncertainty about crude oil prices, and full crystallization of this risk could undermine the disinflation process in many economies, including Ghana.